all of this stuff is incredibly serious, right? There's $350 million supplied in MarginFi today. It's one protocol in a sea of protocols, right? In a space that has struggled for validation from the mainstream, right? We're still incredibly early. We have a lot of institutional players that are evaluating the resiliency of our platform. I wanted to build around these issues, to fix them, to iterate, and to show the capacity that we have to build resilient systems.
This episode is brought to you by Merinade. Merinade is the most optimal way to stake on Solana. You can use their liquid staking token, mSOL, or if you want to stake without any of the DeFi or Peg risk, use their new product called Merinade Native. It's the easiest way to stake your SOL. Go check out Merinade today. What's up, everybody? Welcome to another episode of Lightspeed. Today, we're joined by Rooter from Solend and Edgar from MarginFi. Guys, welcome to the show.
Thanks, son.
Hello. Thanks for having us.
Pumped to have you on. The community's been waiting to have this podcast, so I'm very excited to have you on. I think Rooter's on 7 a.m. time and Edgar is at 11 p.m. at night, so everybody better enjoy this episode for that effort. I'm sure everyone knows what MarginFi and Solend is. We might go into detail. We will go into detail on that, but they're both borrowing and lending protocols that are on Solana, very successful. But the reason why we're having this episode is not only to explore those protocols, but to talk about the risk engines. And all of this kind of started about a week ago or so. I think it's a week and a half ago. This was December 12th. So yeah, 7 days ago. There's some drama that happened in the Solana ecosystem very quickly. So to introduce the parties, there's mSOL, which is Merinade SOL. There's Merinade and Jito. They're the two liquid staking providers and staking providers in Solana. mSOL is a liquid staking token. And a lot of users were going throughout Solana DeFi and using mSOL as collateral, which is what we want. A lot of them were using pretty high leverage because, especially with the points ecosystems that we have throughout Solana right now, you have a large incentive to interact with these DeFi protocols a lot. And sometimes they were providing mSOL as collateral, and then they were borrowing against that to take out maybe more SOL, a USDC, and actually looping that trade to get some really high leverage. Obviously, mSOL is a liquid staking token. It's a derivative of SOL. So usually those trade at around the same value. We've seen even in Ethereum ecosystem, sometimes the LST and the underlying assets, sometimes Depeg shortly for market reasons, et cetera. But at the end of the day, they should converge. But during that, we had a whale who sold about $8 million worth of mSOL suddenly on the market on December 12th. Instead of like unstaking the mSOL and then just selling it that way, or without doing it OTC, just sold it on the market. And there wasn't enough liquidity, and it led to, I think, around a 15% Depeg, which affected all the mSOL that was this collateral in DeFi, and it led to liquidations throughout Solana. Every protocol handled this slightly differently, and that's why we have you two on, because we want to talk about how did your project handle that liquidation that we saw there? And then also just how your protocol was built to deal with that type of scenario in the first place.
Maybe the sequence of events, we should explain a bit more. So what happened was the guy or whatever market sold for whatever reason, and that caused a massive red candle. And I tweeted about it, and I put a lot of question marks, and I was like, what the hell? And then somebody from Solend, so OX Ripley's quote tweeted it, right? And then he said, this is why Solend uses the SOL Oracle for pricing staked SOL assets. Liquidity for staked SOL assets can be shaky at times, everything running smoothly here. And then that mixed some or caused some mixed reaction. Some people from like, not actually just Margin, but probably most notably Margin. And so that's kind of where it all started. So let's maybe kind of replay.
Yeah, if I could jump in here, since it's relevant, because there's definitely been a lot of misunderstanding about why we do this, and it is a very nuanced topic, not really fit for Twitter. So it's pretty good that we're doing a podcast like this so that we can explain it more in depth. Like even people like Frankie had some issues understanding it. So the underlying thing is that we use the Solana Oracle instead of the mSOL Oracle for the mSOL asset. And the reason for that is that it's a lot more reliable. So throughout the last 2 years, we've seen many issues with the mSOL Oracle. This is to be expected somewhat, given that there are way more quoters on the SOL Oracle. For example, there's 31 versus 14. The confidence intervals are typically 80 to 90% higher for SOL. And historically, like, as I said, there have just been a lot of issues with mSOL. Probably, like half a dozen to a dozen times there have been like minor depegs and whatnot. So throughout all these issues, we just realized that it's safer to use the underlying. And of course, there are some trade-offs, but basically at the end of the day, we believe that the trade-offs are in favor of this. So to go into slightly more detail, this is still resilient because Solend is underestimating the price of mSOL, because the price of SOL is always going to be lower than mSOL. So a depeg would have to be quite significant, more than that underestimate, for this to be problematic for Solend. So like in this recent example, nothing happened on Solend. There were no wrongful liquidations or any liquidations really, because the buffer was enough to account for that. And like you might, it's pretty weird looking to use like the different asset price, but in this case, it's actually okay because mSOL is not borrowable. Because you could imagine usually if you're underestimating the price of an asset, then that would let people borrow more than they should, right? But it's not borrowable, so that's not an issue here. And then to explore like the issues with this a little bit, hypothetically, if mSOL went to 0, SOL would probably crash as well, in which case using the mSOL oracle alone wouldn't save you from bad debt. Like if SOL is crashing, you're going to have issues anyway. But granted, like pretending that SOL didn't crash, we do have other mitigations in place that would limit damage. So for example, we have a global outflow limit, which we added in V2, that limits the amount of funds that can be withdrawn in a short period of time, similar to how Wormhole has something similar for bridging. And also, basically, the probability of mSOL just getting hacked and going to 0 is like basically this tiny non-zero possibility, like epsilon, because the contracts are super simple, and like you can't compare something like that to UST as McBrennan did. It's quite a different situation. So yeah, basically those are the reasons. To sum it up, it is a trade-off, but we'd rather protect users from real recurring issues that we've seen multiple times in the past. Irrational depeg like this, just a whale selling something off, or like KISS Oracle issues due to quoters just having issues. And yeah, we'd rather protect users from these real things versus this theoretical issue that we have other mitigations in place anyway, and it's like super unlikely. So it's really a pragmatic, practical approach to our risk. And basically, I was just a little bit disappointed that, McBrennan and MarginFi decided to publicly attack us about this, which just shows a lack of understanding of how our risk management works and a lack of goodwill, especially since there was an actual oversight that we found on your side, a real loss of funds vulnerability with the way that the WST ETH oracles were handled. So yeah, just want to lay that out, and we can have a discussion about it.
Got one thing I would like to add, Edgar, maybe before we can hear from you is, Ruder, maybe can you just explain for listeners that maybe don't know how all this works that well, and that you were talking about mSOL should basically always follow the price or be slightly above the underlying. And a large part of that is just because there's arbitrageurs that would come in because of how the epoch period's only 2.5 days. Could you maybe just explain that, how a depeg can happen, but it should not last for a sustained period of time, and they should, at the end of the day, converge?
Yeah, for sure. So mSOL started off 1-to-1 with SOL, but as staking rewards are accrued, basically the price of mSOL goes up. And this is in contrast to another approach that has been taken, which is rebasing tokens, which basically instead the price of the asset is always the same, but your balance is always increasing. For example, this is how staked ETH works on Ethereum with Lido. And that's why they have like wrap staked ETH, which converts it into the mSOL style thing. And so basically, these are like different assets that get traded. They have different tickers. And, prices are just determined by order books. So it is always possible that someone can trade something out of where its theoretical underlying value is. But yes, with mSOL, there is an epoch. So every period, you can unstake. You can stage your SOL for unstaking, and then at the end of that period, you can get it back. And basically, so you can redeem the underlying, which creates this arbitrage opportunity anytime that it depegs. And this is, this really means that the intrinsic value of mSOL is like pretty tethered to the underlying.
So to make it simple, for example, you saw that mSOL was trading at a steep discount like it did in this scenario, but you had a strong belief that it's going to regain its peg because the Merinade contracts, for example, are not hacked. You could buy mSOL on the market, which is say trading at 80 cents on the dollar, and you go put that and try to unstake SOL, and you'd receive that SOL that's trading at 100% of the value, and you would capture that arbitrage. So, Edgar, I'd love to just hear your thoughts on how you think about this and maybe some of the trade-offs between the two strategies.
Yeah, definitely. First of all, thank you for having me on. I've been obviously thinking about this problem, more holistically, definitely quite a bit since we had the conversation online. Oracles are also, just a very critical component in a lot of DeFi systems, and I think a component that has had like stability issues on a number of fronts throughout their entire existence, right? And so I think they're it's easy to understand why they're a point of anxiety in relying on these systems, right? With mSOL specifically, and our view on how we think about pricing assets, in my view, the number one challenge that a lending protocol has in front of itself is managing solvency risk, right? Solvency risk in principle is pretty simple, right? It's the risk that liabilities on the platform outpace the value of assets on the platform, and that lenders, those that have deposited into the platform, are not able to withdraw their full value, right? That they've lended. From an addressable market perspective, I think that lenders outnumber borrowers on a user basis, something like 99.9% to 1, right? When we think about how we're building MarginFi in the long run, right, from an app perspective, from a user experience perspective, we are primarily thinking about lenders. Because if you look at like the way that an average person interacts with the personal finance system in front of them, right, crypto or not crypto, the very first piece to building passive wealth, right, is compounding that wealth through lending it out somewhere and accruing some kind of yield, right? This was when I pitch MarginFi, when I pitch DeFi to the friends that I have that are outside of crypto, right? I always bring up the bank account that was supposed to give them all this yield, right? And the way that it kind of never happened, right? Even though bank accounts technically, at least in the US, right, and in many other places around the world, they do provide some kind of yield for your capital. Generally speaking, this idea that we were sold on, right, that there would be yield, for our money that we have to put away, didn't really come true, right? And I think that lending platforms like MarginFi, like Solend, like Aave, like Compound, right, like others in the space, are an important bridge to this problem, right, and to helping users attain that real yield. That means, right, that when we think about risk, we are often thinking about the lenders. I would actually say that we, generally speaking, prioritize lenders before we prioritize borrowers. We found borrowers to be much more sophisticated players, ones that are a lot more flexible to manage the implementation of their various strategies, and generally adaptable, right? And so they can kind of live, with a higher bar for action and reaction to the market. And they're generally happy to do that. They're happy to pay for it, right? We get one of the most common points of feedback we get these days is that borrowers are willing to pay more on their platform, on our platform, than they're building today, right? Than they're paying today. And that just speaks to the elasticity of their behavior, right? With respect to oracles, to address your question directly, Garrett, we like to price assets to their market price, agnostic of what asset we're talking about, right? That doesn't just mean mSOL. It also means, or any other LST. It also means stablecoins, right? If you look at USDC, USDT, right, these are assets that are designed to be pegged to the US dollar, right? In practice, are generally pretty close, but have seen depegs on their own, right? Now, to Ruder's point, I think there are some there are some interesting trade-offs, and ultimately, these trade-offs are like subjective questions that need to be answered by protocol designers, by the communities that support those protocols, right? I think it's very valid to say, look, we want to protect against some kind of depeg because we feel that the asset will come back to some theoretical price, and we can save our borrowers from liquidation on that front, right? It's a valid perspective, and I can see how that perspective gets backed up, right? At the same time, I mean, finance is an industry, I think, is a dangerous place where a lot of theory, right, has fallen apart. We saw this, I mean, in 2008, right? Sometimes even down to just the distribution assumptions that are made under the risk models that are put together, right? This is one reason why all of the modeling that we do off chain that helps us decide on the risk parameters, they're implemented MarginFi, and I'm happy to talk about that if that's interesting. But we're leveraging tail risk scenarios, right? And there's a lot of time spent on designing what a tail risk scenario means, because assuming that things will continue to go well is, I think the antithesis of risk modeling, right? At least from my perspective. And so to that end, right, we continue to look at market prices regardless of the asset that we're considering. Now, this does mean that in a scenario where mSOL depegs, right, for long enough, and users are liquidated, and then mSOL repegs, right? In theory, assuming that the duration risk is something that the platform could handle, things would be better, right? There would be less liquidations. But liquidating users earlier, from our perspective, is a matter of safety, right? It's a position that we take to say, look, the first thing that we want to protect is insolvency on the platform, right? Ultimately, that affects the lenders positively more than anything else, right? And we are willing to forego the opportunity to boost our, the potential solvency that borrowers have on the platform in order to maintain safety, right? This could be viewed as like a more conservative view, right? And I think we're fine with that. I think lending in general is a conservative effort, but it's something that we think is important to react to in case mSOL doesn't peg back, right? Which we've seen with other assets, right? There's a number of depegs that we can talk about historically speaking. In the case of mSOL specifically, MarginFi didn't have any meaningful liquidations, and that's because the market price oracle that we use it follows an exponential moving average with a 1 hour time window, right? And all that means is that it reacts a little bit more slower than market price does to factor in for stochastic volatility. Now, that in itself is not quite as conservative as it could be, even if we're following the line of argument that the market price is what should be looked at, right? And so you can start seeing immediately how like the last layer, and I don't know if you guys had a chance to read, Gauntlet published an article today. Tarun wrote it on just risk management in DeFi, kind of high level themes there, implementation approaches. One of the great points that that he made that I think is the hardest to explain more broadly is that the last line of risk management is always subjective, right? You can take best practice approaches, you can take a principled implementation, but at the end of the day, you have to make business calls. And so we do make a business call to run a market oracle, but also to run it under a moving average implementation. And we like that middle that we find with that.
Yeah, I'd like to take a minute to respond to some of these. So I think our number one goal is to be practical about risk management. And basically, we feel that the mSOL Oracle in its current state is not the best way to secure hundreds of millions of dollars. Of course, pricing assets exactly to their market price is the ideal. If the Oracle was more reliable, we would definitely switch to it. But unfortunately, that's not the case, especially given what we've seen in the past and just this last week. A single player who is, called a whale by us, but that's actually a really small user. Like there are tons of people in the world that can affect the price like that, right? And this is like an unintentional side effect. But imagine if someone was doing this maliciously, right? So basically, yeah, I'd also like to say like we wouldn't really say we could prioritize lenders over borrowers. I just think we value everyone. And again, like this is the practical approach that we've taken, that we feel that given all the trade-offs, this basically results in less issues. And just want to respond to something you said as well. You mentioned like liquidating early, like you prefer to liquidate early. In many cases, liquidating too early is the same as wrongful liquidation. Like we've seen some Oracle issues in the past where the prices were off by like 10, even 20% for no good reason. Like, and the way that Pith quoters quote is a little bit of a black box. So like we don't really know exactly what was going on there. But this liquidating too early, too eagerly can result in wrongful liquidations, which we definitely want to avoid for our borrowers, as well as we want to keep lenders safe. And then finally, you mentioned that you guys use the EMA, which it definitely has some benefits, but it also has some trade-offs as well, right? Because you mentioned, you would be liquidating more slowly, which in the context of a competitive environment, that basically means you'd be the last to start liquidating. And potentially that could be really bad if there are any cascading effects, right? You'd essentially be liquidating at the worst prices, and your users would be getting the worst end of the stick. So, yeah, just wanted to mention those.
Well, I mean, in the context of like an mSOL situation, not as late as you guys would be, right? Because the whole proposition here is that using the SOL Oracle helps maintain a stable price on the platform and therefore doesn't open up positions to liquidation, right? So it's like the one theoretical side of the spectrum is the second that market price hits, underneath a liquidation threshold, right? Things are exposed to liquidation that instant second, right? Market price on its own is something that, the definition of that is something we can debate, right? Because assets don't have one price in the world, right? Like if you look up the price of Bitcoin, like that is a theoretical price that doesn't actually exist. The price for any given asset is what you can get for it. The market price for a given asset is what you can get for it on a given exchange. But as you move along the spectrum, you start to employ some kind of moving average approach, right? And it is true that you could have a smaller time window for a moving average. We like the 1 hour time window. It's far from finalized, I think, in the long run, right? Oracles are definitely focused on stability most of all. We think Pith is head and shoulders above any other Oracle implementation that I've seen in crypto. Not only do we like the data providers that are behind the scenes, we built relationships with, a good portion of them as we've gotten to know them and become more reliant on the infrastructure. But some of our related entities are data providers themselves. And recently we've been pushing for more providers. I don't know if you guys saw this on, publicly. This is something that Mac is running as well, pushing for more providers to start contributing to Pith, right? Because one of the best ways to improve the robustness of an Oracle platform is to diversify the data providers. And it's something that we've, proactively started, trying to help, right? Not just from an internal perspective, but from a partnership perspective as well. We've, obviously, because I know I'm shilling Pith a lot, we've had great conversations with Switchboard. They're an Oracle provider that we use and we love, for a different set of reasons. I think they come at Oracle implementation and general service providing from a different perspective, or product offering from a different perspective. I think ultimately this involves making some kind of liquidation and user smoothness experience trade-off, right? You can always be safer if you liquidate earlier. I don't think I agree with the notion of the term wrongful liquidation. And that is, unless it speaks to a mechanism failure, right? Mechanism design, I think, can create unfavorable liquidations, right? Maybe liquidations that users are not happy with. But the term wrongful liquidation, in my view, should be reserved for mechanism failure, right? Where mechanisms don't act as designed and you get problems from that perspective, right? I think the difference between liquidating earlier or later, that's much more subjective, comes with the trade-offs that we've been discussing.
Yeah, I mean, to expand on the wrongful liquidation part, I think in this specific example scenario, it was more of just a price movement, and the Oracle was reflecting what was happening on the markets. In the past, we have seen like Oracle staleness issues and just weird pricing that doesn't match up with anything that we actually see on the market, which we would use the term wrongful liquidation for. And that said, like, yeah, I know I realized like I've been mentioning Pith and our oracles a lot. I also want to say that we love them as well. We've worked with Pith and Switchboard super closely since we launched. We were actually like using Pith in their beta, and I think we were like the first project that launched. We'd launched like a day or two after they went to mainnet. We were basically like blocked to launch by that. So yeah, we really love them, and we think that they do amazing work as well.
All right. So I want to wrap up this Oracle chat and the incident in a sense with the Depeg. So I do want, because I think we got a little technical on multiple fronts there. I do want to maybe do a final session for just takeaways, right? So I want each of you to kind of maybe discuss maybe because people are obviously listening to this, maybe they want to use Solana DeFi, Solana Borrow Lend, maybe they're bigger players, maybe they're smaller players, whatever. What should they take away from this incident and how you guys approach risk management in general? And we can do, I guess, Edgar first and then Rooter after.
Sure, yeah. I think the main takeaway is that as an industry, we should be talking way more about risk management. Like, we had a bunch of conversation online, right? Tarun published an article. Rooter and I are on this call. We should 100x it, right? The conversation in general. And I think, I was thinking from the perspective of a user, if I'm going into this, situation, I'm trying to figure out which platform to trust. There is a sea of information. It, I think, can be 100 times cleaner than it is today. I think all of this can be communicated to users much, much better. That's the main takeaway for me. It's pretty abstract, right? I think the second thing I would think about is who cares about this, right? Which developers, which teams are taking the time to talk about it, to highlight their progress, their evolution, right? This is, I'll call us out here. Like, this is something I think we can be doing a lot better, right? We've done a ton of risk management work behind the scenes. We're running some really interesting multi-layered forecasting models that are looking at tail risk scenarios when it comes to market depth, when it comes to depth recovery time, when it comes to price volatility. But Camino's got a great dashboard that highlights a ton of interesting data points that users can go and access that we don't have, right? I think we could be doing a lot better on that front, visualizing this information. And it's inspiring to see people kind of pushing in this direction. So to me, the takeaway here, right, is like we could debate a lot of these details, but I think in general, this conversation needs to be happening a lot more, and it needs to be synthesized a lot better for users.
Yeah, I'd agree that risk management could definitely be talked about more. It's a little bit of a tragedy of like capitalism or something and what I mean by that is that that kind of content doesn't get all the engagement, right? Like people want to see you being risk on and launching shitcoins and doing those types of things, right? High LTVs. But it's kind of a thankless job too, right? Like no one appreciates it until you save millions of dollars from loss. But if you do save them, like no one notices it, right? So yeah, it's a little bit of a tricky one to get everyone talking about it. So I definitely appreciate your efforts in trying to get this out more, and we want to support you and do this as well. It's also kind of funny. Like I've noticed everyone says security is number one. Many teams say that, and I was just thinking like, there's no way that everyone is actually like security is actually number one for that many people, right? And it's a bit of an unfortunate thing. It's just like crypto is this unique asset class that has so many security considerations that, you know, everyone wanting to build something has to be an expert in all these different things. But maybe someone just wants to build a cool like social app or a cool game. And yet security still has to be their number one priority. But it's tough to do because not everyone can have like a background in risk management and smart contract security, etc. But what I'd say the biggest takeaway they should take from here is that for Solend, the number one goal that we have is being practical about risk management. We'd rather save users from losing money unnecessarily than taking on some kind of like theoretical stance just because it's like correct by the books. Which, you know, shown in this example here, how we're using the SOL Oracle to price mSOL. Basically, just given all the trade-offs, we feel that it's a safer choice for now. But in the future, when situation improves, then we can change that.
As a listener to this show, I'm sure you own some SOL. And if you do, the question is, are you staking it? If you want to get started with staking, you should check out Merinade, which is the most optimized way to stake your SOL today. Staking by yourself and choosing one validator, that puts you at a lot of risk. You don't know if that validator goes offline. You have to constantly monitor it. You might not get the best risk-adjusted return. Instead, use Merinade, who monitors all the validators throughout Solana, then chooses over the top 100 best validators to delegate to. So all you have to do is go to Merinade. They'll automatically delegate your stake in the most optimized way across these validators, have the best risk-adjusted reward that's based on inflation, also fees, and MEV. So once you choose Merinade, there's two ways to do it. If you want to play with DeFi, they have a liquid staking token called mSOL, Merinade SOL. You just stake with Merinade, you choose the liquid staking option, and you'll get your capital back immediately that you can play throughout DeFi. Now, some people don't want that DeFi contract risk. They don't want that peg risk between the LST and the underlying asset. They just want to stake and earn rewards. Well, Merinade has a product called Merinade Native, which is a way for you to get the best parts of Merinade, but without that LST and DeFi risk. Merinade's been around for over 2 years. They have 4 audits from some of the top security firms in crypto, and they're also the largest LST provider in Solana. So why not get started today? Go check them out. Put a link in the show notes, go play around. You'll see why Merinade's only possible on Solana. Now, let's get to the show.
I agree. Obviously, we need to talk more about risk, but I'm probably going to get a little spicy here because there's definitely a disagreement here, right? Like I think one of you believes the other's approach is maybe too theoretical, or there's something that you would do differently. And so if we were to just dumb that down to anybody listening who doesn't understand borrow and lend, what is that core philosophical difference? Like what is causing all these disagreements between the two parties here?
I think my hunch is that Solend has been around for a while and we went through many different incidents. So just to list a couple, there was a lot of Solana downtime, network issues. There's one that was like 17 hours, but for some time there was one like every week, and that was basically an incident for us. There were multiple Oracle mispricings that caused incidents. And then later there was the depegging of UST. At the time, Solend had UST as an asset listed. So that was a pretty crazy market scenario. There was a collapse of 3AC plus all the contagion. There was the collapse of FTX, of course. The price of SOL dropping from $250 to like $10 in a pretty short period of time. Also with FTX, there was BTC that just suddenly became unbacked, and we had to deal with that. So basically, through dealing with all these issues, we found that like the best way to protect against these things is to be very on top of things and quick thinking, and that you can try to prepare as much as you want. You can like choose your oracles super meticulously, but something like it's not going to stop these things from happening. At the end of the day, there's going to be some intervention that you'll have to take for these idiosyncratic type events that are like very hard to predict, and each one is super unique. And I think this kind of goes back to what you were saying, Edgar, about Tarun's paper, where he mentioned that like things are very I forget how he said it, but like yeah, I think he was alluding to this basically, that there are these very like one-off risks that happen. So I think this is what drives our philosophy on these things. Yeah, go ahead.
I mean, I think Mert, this is, this touches on, I think you make a good point, right? There's a disagreement, but we're both saying the same things, right? I think both sides seem like they'd rather operate in a more practical way, in a more actionable way than a more theoretical way, right? I don't disagree with that. I don't disagree that looking at more tangible, grounded data, making decisions based off that data is smarter, right? I think the things that we prioritize underneath that abstract layer, right? How we actually go about doing that from our perspectives, I think is different, right? MarginFi is definitely newer than Solend, right? No question there. I've been working on risk engines for a little over a decade, right? Personally, started my career at Goldman Sachs, right? I was working on leverage risk models, looking at, it was a $90 billion platform at the time. We were talking about individual vehicles that were, from like 300 million to like 7 billion in size. And we were looking at institutional LPs, how to solve that balance of risk and reward that comes with leverage for them, right? Post the recession, right? In an industry that was just absolutely scarred by the experiences that they went through in '08, where a lot of their theoretical assumptions fell apart, right? This is maybe not as spicy in this group, but like, when I talk about why we decided to build on Solana, why we like high performance infrastructure, right? I talk about how risk management, to Ruder's point about reacting quickly, talk about how risk management is really like two things, right? If you take an analogy, you're flying a plane, right? Let's say it's like a cool fighter jet, whatever, and you're flying through the fog. You kind of have two things you can rely on to like not run into something, right? One is the sensors that you build, right? Sensors can tell you what's going on in the front, and maybe you don't see it with your own eyes, right? But you have some idea, right, with some predictability of what's in front of you. And then the second thing that you have is you have this steering wheel, right? Or whatever it's called in a plane. I've been telling this analogy so much, I still don't know what the steering wheel in the plane is called. So I'll take that one on me. But at the end of the day, right? Like no matter how good your sensors are, if you're flying and your sensors don't catch something and something comes out of the clouds, you can jerk the steering wheel, right? And the speed at which your steering wheel reacts and pulls your plane to the side, that's critical, right? And both sides of this problem are important to work on, right? Our risk models, like I mentioned, the conditional value risk that we look at, the market depth, the depth of recovery, those are our sensors, right? They give us, we look at, like I mentioned, tail risk scenarios. I think like Solana, for example, we assume that on any given day, Solana will drop 80%, right? Over the course of the next 24 hours, it's double the historical drop that we've seen Solana ever do, right? And that's just like a starting point for us, right? That's fine. But at the end of the day, right, like no matter how good your sensors are, you need a steering wheel that can jerk you in the right direction when things come out of the clouds. And I think that's actually a big part of that is high performant infrastructure. That's Solana, right? It's also the high performant liquidators that sit off chain and that contribute to your protocol, right? We spend quite a bit of time building high performance infrastructure across the board. We've got a great team with relevant backgrounds for it. They really love the opportunities that Solana and that the infrastructure around it gives them to run. And I think that's a key part to solvency risk. So again, yeah, for me, because I listen to Ruder and I, and we're not the only ones, right? saying a lot of the same like high level kind of principles. And to Ruder's point, like everybody in the industry says that security is number one, that risk management is. You don't see anybody being like, "Hey, I have a lending platform and I hope it blows up. I'm trying to build something that explodes." Like people are not going to say that, right? I think what it takes is going one step deeper and saying, okay, like do I align with this team's methodology? Do they seem to me like they're prioritizing it? And then thinking about your actions from there.
Edgar, I'd have 2 follow-up questions just for the audience. You talk about the speed of liquidations and how important that is. Can you explain? I'm assuming that's important because 1, you don't want bad debt for the protocol, and then also you need liquidator profitability. Can you talk about those 2 things and how important they are?
Yeah, for sure. So, I think liquidator profitability is the number one most important metric from the liquidator perspective, right? As a liquidator, your job is to shoot for opportunities that you have to liquidate positions, right? Those opportunities are determined initially by protocol constraints, right? So, on MarginFi, we have the concept of a health ratio. Your health ratio goes below 0, you're exposed to liquidations. The protocol makes that decision, right? And from there, it's on third-party liquidators that are sitting outside of MarginFi, right, the protocol, to go ahead and liquidate your position. Now, this is really interesting, right? Because, when folks think about risk management, when it comes to lending protocols, they're often thinking about the protocol itself. But the protocol itself, at least under traditional circumstances, can't liquidate positions entirely on its own, right? Like when a position, goes below 0, with its health ratio, in that moment, in that immediate moment, nothing happens, right? And it needs to wait for a third-party liquidator to come and liquidate that position. This is, Gauntlet wrote about this in their article today. This can be framed as a principal agent problem. You can view liquidators as agents. They work, they optimize for incentives that matter to them, right? From a liquidator perspective, what matters to you is profitability. And I think that, it sounds kind of obvious, right? Like, okay, like, we have a liquidator or there are a bunch of liquidators, they're going to go and liquidate for profitability. I think what really matters is understanding that, like, if liquidators are not confident in the moment that they will be profitable, they won't choose to participate in a liquidation scheme, right? And that means that in the worst moments where there are issues that cause liquidators to lose faith in their profitability or to run measurements against, look at their analytics, recognize that they can liquidate, but they won't be profitable liquidating, right? Those are moments that we should expect liquidators not to liquidate. And we should expect those parameters to be built into liquidators programmatically, right? Like if I'm building a liquidator myself, I'm just Edgar, the engineer, right? I am building a liquidator that will check to make sure I'm profitable on every single liquidation. And if I'm not profitable on that liquidation in a given moment, I'm not liquidating, right? And that means that I could be removing myself from a group of actors that's been relied on, right? To maintain solvency for this lending protocol, right? I think this is like a really important incentive problem to solve for. It is the crux of our risk engines. When we look at market depth, when we look at depth recovery time, when we forecast tail risk scenarios there, we are benchmarking everything we do off of the idea that liquidators will only take action if they are profitable and will immediately step out of the game if they find themselves to be unprofitable. I think this is like an incredibly important and still very under discussed part of lending protocols. And I think there's a lot more that can be done on the liquidator front to incentivize them from the protocol perspective. It's something that we hope to push and speak a lot more about at Margin going forward. But historically speaking, right, like liquidator profitability, obviously, I think a key metric. To touch on Garrett, your mention of high performance and kind of liquidators winning those liquidations, right? In a situation where the liquidator environment is competitive, right? The speed that your liquidator can operate at, how performant those trading systems are, right? is critical towards your individual profitability as a liquidator, right? Now, note that like it's a good scenario if liquidations are competitive, right? And generally speaking, in the good times, liquidations continue to be competitive. Lots of liquidators are shooting for those profitable opportunities. What is important from our perspective, we think less about we think less about helping liquidators in profitable times, right? In good times, we think that the market will compete on its own there. I'm constantly thinking about tail risk scenarios, right? Like my entire day is waking up and going, all right, like Solana plummets 80% in a day, right? Market depth is at, P95 bad, right? Everything is, everyone's pulling out, things are cascading. We work with a team called Fibonacci Finance. If you guys are familiar, they provide a decent amount of the data that we use for our systems. We've talked to them about contagion risk, right? Understanding how waterfall liquidations across platforms in an ecosystem can affect MarginFi in this case, right? I think those tail risk scenarios are pretty much all that matters from a risk management perspective. Obviously, you balance business interests on the other side. But yeah, for me, I'm a lot more worried about what it takes for liquidators to continue liquidating when things get tough than I am about what it takes for liquidators to win when things are good. I'm going to drink some of this. I got European McDonald's for the second time in my life, so if you see me with the Coke, it's just taking advantage.
Nice. Some things I'd like to add there. So I think it's important to clarify that it's not about the fastest liquidation. It's about the best execution as well. Because being the fastest just encourages spam. You get liquidators doing spray and pray, and because of this, they use DEX only liquidity and end up getting pretty bad execution, and especially for larger sizes. So like this is something we saw given that liquidations initially on Solend V1 were all about whoever lands first wins. But in Solend V2, we changed it to this kind of auction model where basically the bonus that the liquidators get is slowly increasing over time. And so whoever feels that they can liquidate with good execution such that it is profitable, they're able to take advantage of that and win that liquidation. Whereas, like, let's say someone else who doesn't have access to centralized exchange liquidity has a lot of slippage, like they wouldn't be able to liquidate, and so they don't win that liquidation. So yeah, I just want to emphasize that it's not just about speed. For liquidations, it's speed and execution as well. Another point that's I think pretty interesting is that
I like the auction model. So
nice, thank you.
Just gonna give my support there. Go ahead.
Nice. So one thing we saw during the FTX crisis is that all of the third-party liquidators basically left because Solend was mostly run by the liquidations were mostly run by third-party liquidators. Like when we first launched, we created a reference implementation of a liquidator that we open sourced, and we encourage people to take it, improve it, and run them. And so we had many people running liquidators, but it was very interesting that they all left when there's a lot of uncertainty. So another key thing is that it's not just about profitability, it's about like the expectation of profit. Because during FTX, it was actually an extremely lucrative time to run liquidators and ARB bots. You could have made in a day what you would have in like the whole year, if not more. But a lot of people were just, there's so much uncertainty around exchanges and just everything, so much chaos in the markets that a lot of people just stopped liquidating, and that was pretty problematic. So yeah, since then we've improved our liquidator a lot. We have a super high performance liquidator, and we also still have some third-party ones that are competing, and it's better for the whole system since it improves everyone. But yeah, we have like much better high performance liquidation engine right now.
We run all of our risk models off of the idea that only the in-house liquidators that we manage ourselves on the core team are operating. We effectively assume that every third-party liquidator will leave if things get uncertain, right? Which I think is it's what you have to do because there's so much uncertainty and the expectation. The sentiment can change so quickly, right? That relying on them, I think, is dangerous from a risk perspective. It's a conservative view, but I think it's the right one.
I don't know how much more time we have left on this, but there is some other stuff I want to touch on during this episode, if I may.
Yep, go ahead.
Okay, cool. So I guess to set the stage a little bit, the whole reason we're here is due to some Twitter drama, right? So start off with Ripley's from our team posting something about how we do things technically, and then McBrennan from your team retweeted it saying that this is why he's, I forget the colorful language he used, but it's kind of disparaging our risk management and whatnot. Why he's like terrified of whatever, rather than bringing this up to us privately. And this kind of highlights a pattern that we've been seeing from MarginFi. Basically, many examples of people from MarginFi making things up about Solend. So some examples, a couple months ago, there was a tweet that was saying that all Solend TVL is just Alameda. And of course, that's not true if you actually take a look at things. Coupled with that was like, oh, Solend V2 has no TVL, it's all in V1, which also isn't true because it's an in-place upgrade. So it's the same liquidity. And we even were back-channeled by an ecosystem project that you told OKX not to work with us because we're, quote, sketchy. So this has been a pattern, and we have talked about this before, Edgar, one-on-one through DMs and in a call. And I remember you said like that you let people on the team speak their minds and that you try to verify everything internally as vigorously as possible, which is a little bit hard to believe because some of these things are, very obviously not true, and it doesn't take too much to actually verify them. And basically our approach on this was that we just ignored all this for a long time, for months, just hoping that it would go away, I suppose, or, not thinking that it was too big of a deal, but it really ramped up and continued. And it got to a point where we kind of had to respond because, you guys have been growing a lot. There's a lot of engagement on this type of stuff, and it's been pretty damaging as well. So, yeah, I'd like to address that. And basically, Edgar, like we've chatted, and like I feel like you're a really good person, and the way that you act is super different from other people on your team. But I want to point out that it creates a little bit of a good cop, bad cop routine, whether it's intentional or not, where basically you let McBrennan on the loose, making a lot of drama, and then you're super nice about things, but you don't do anything to stop it. And in many ways, the inaction of doing anything about it, your inaction is endorsement in itself. And I think it would be really great for everyone in the Solana ecosystem, since I've gotten a lot of private DMs about this as well. I think it'd be really good if we could set this aside and we never really came out attacking you guys. I think every time we've said anything, it's been in response. So yeah, it'd be great to improve things for everyone. I think the drama is fun to watch for everyone. Got a lot of engagement on this podcast teasing, as you were saying before we started recording. But I think this would be great to clear up and have a more collaborative ecosystem going forward.
We've had conversations about this internally, multiple times, definitely in the past week since all this conversation has gone on. We're the intention was never to antagonize anybody. The intention is not to run like a good cop, bad cop routine. I am not going to say that our execution is perfect on anything, right? We're constantly working on trying to improve the way that we do things. We disagree internally on the team a ton, and I think with such ferocity that if folks were part of the private conversations that we have, I think it helped them recognize how much we defend our own views and opinions internally amongst ourselves, right? As much as we, talk about our perspectives publicly. The one thing that maybe the thing that I was thinking about, I was thinking about this over the weekend. Maybe the thing that we'll disagree on the most is the value of private conversation versus public conversation. And I think, from an ecosystem perspective, like from a partnership perspective, I do think finance is a multi-venue play. Right? I think that's really important. It's a really strong belief I have. I think if MarginFi is the only lending platform on Solana or within the relevant space where, we're compared, I think that's a problem. I think it's a huge problem, right? I think there needs to be like a critical mass of multiple venues. And so all we want, right, is folks around us building comparable solutions that we think are of good quality, right? Or solutions that, can take different implementations, but that we think, generally speaking, is of the right quality. That said, I think that public conversation is super, super important. And I'll tell you this story from from a different kind of angle. We had a conversation with a team over the weekend. I won't mention who. It doesn't really matter. They brought something up to us privately, and they said, "Hey, we're bringing this up to you privately, right? Kind of in as a note to this private public conversation that has happened last week off of Twitter." And I got to be honest with you, my thought when I read that was, I wish you brought it up publicly, right? Because I think that I get the idea that this is creating unnecessary drama. I get that perspective. I think what's more important here is the fact that this is spurring public conversation and highlighting the the opportunities for improvement across the entire ecosystem, right? I have never felt better than this past week when, a number of folks from the Solend team and, from other teams started like really poking at MarginFi, right? And finding like the smallest bugs. We've been on fire. It's been great, right? I'm sitting here, I'm going, this is what a community effort to really battle test the resiliency of something feels like, right? Because to me, like, all of this stuff is incredibly serious, right? There's, $350 million supplied in MarginFi today. It's one protocol in a sea, in an industry of protocols, right? That's incredibly serious capital in a space that has struggled for, validation from the mainstream, right? We're still incredibly early. We have a lot of institutional players that are evaluating the resiliency of our platform, of this industry in general. I'm not interested in meritocracy. I'm just not like from the perspective of, hey, like, do the MarginFi guys, does the team try hard, right? Do they put in work? I flew to Europe to work in person with our CTO because we have work streams that we're pushing on in this moment, and I up and left and flew halfway around the world because sometimes like that's just what it takes, right? But it doesn't matter if we don't execute, right? And so I'm just extremely execution oriented. I've been in, a lot of our guys come from mission critical industries, from mission critical backgrounds where we've seen people, great people, put in a ton of effort and fail, right? Fail terribly sometimes, and sometimes at the cost of many people around us, right? And so I guess we've just kind of, as an organization, we've just learned not to think about much more than execution, right? Now, that said, I think we're happy to, we've made the decision already internally that like we'll have conversations, more privately. We're happy to, put in more work to make sure that the right information is being passed on and that the conversation is constructive, right? But like, please, like, to anybody watching this, to anybody on this call, like, if you guys see a flaw in MarginFi, like, put it on the front page of the New York Times. every single time because I want to see it as fast as possible. I want to hear about it as fast as possible. And I want to give our team the opportunity to, to build around these issues, to fix them, to iterate, and to show the capacity that we have to build resilient systems.
Yeah. I guess one quick note, you mentioned that people, Solend, have been poking at MarginFi and that we found the smallest bugs. I think it's a bit interesting to downplay it like that because the bug actually was value at risk, the issue with the wrapped staked ETH Oracle. So yeah, I wouldn't downplay it like that.
I mean, it was the same Oracle situation that you guys had with mSOL, right?
No, it's quite different. We can get into it. Basically, you guys are using the staked ETH Oracle price, which that is earlier at the beginning of the conversation, we talked about the rebasing approach versus the asset that's increasing in price. So it was using the rebasing token price, which is basically pegged to ETH. It's like trades slightly above just due to market stuff, maybe like 1.03. But then the actual wrapped stake ETH is like 1.15. So that's like quite a significant difference. And the asset actually was borrowable. On Solend, mSOL is not borrowable. And therefore, underpricing it actually does open you up to, people being able to borrow more than they should and just walk away, leaving the protocol with bad debt. So it's quite a different situation there. And as for just the general public discourse, I do agree with you that putting things publicly is good, but I feel that the way that you guys have been doing it has been more slanderous than anything else. It's not really constructive, especially given that a lot of things have just been flat out wrong, just made up. And another thing I'd like to say is like, we basically had this conversation a couple months ago in private, and you were saying the same things that we're going to do better, we'll be constructive, I'm going to talk to the team, but nothing really changed. We continued having these kinds of issues. So like, TBH, I won't really believe this until I see it in your actions in the next couple months publicly. So I think it's really great what you're saying, but I've kind of heard it before and didn't really pan out. So yeah.
I'll check back in. We can make a public or private statement on the SC Oracle. I know it's an isolated pool for us. My understanding is that we were, this is all a conversation of Oracle abstraction, effectively, right? And we were leveraging an Oracle abstraction very similar to what you guys were doing with mSOL and SOL. Again, I will check in on the details there. I know that bug was fixed. I'm glad it got brought up. Again, I'm going to come back to my perspective. Like, I'm glad it got brought up. I'm glad it got brought up publicly. I'm glad it got brought up as soon as possible. Right. There were other UI bugs that, have been highlighted. We've got a 3,000 person Telegram community, which, puts just as many messages into the Telegram a day. That's constantly highlighting other issues. I wasn't just talking about the Solend effort, although I'm, grateful for your guys' contribution. Look, I think we are going to continue to, on my mind is the solvency of MarginFi, right? I want lenders to maintain their solvency. I want them to be able to get their funds back. I want borrowers to have a good experience on the platform. I think I'm happy to continue to manage ecosystem relationships appropriately. I think if the success of anything we're doing comes down to the relationships of a few people, I think we've failed massively on the decentralization front, right? And so all I'm thinking about is the autonomous systems that we're building. That's really what's on my mind.
I am hoping that we can have better relationships in the future. I did want to kick that off a little bit by saying 3 things I like about MarginFi. So number 1, I saw your light mode. I think it's a really great idea and quite well executed. I think, it really simplifies the UI for new users. I think you guys are a really ambitious team who ship a lot. You guys are super active, and yeah, you've been doing a lot of things. And third thing is you've had some really impressive growth, which, have to commend that. So yeah, hopefully this can be a good kickoff to a better relationship. I just want what's best for the Solana ecosystem, and I think a more collaborative environment is better for everyone.
Well, I appreciate the compliments. I know the team worked super hard on the new UI look. Code is open source, right? Please feel free to reference it if it becomes interesting. That's to you and anybody else who's listening and interested in it. We're always experimenting with new things. I will say that the Solend UI is still my personal favorite. It just makes, I don't know, I just like it. But we're not building for me, and I often disagree with a number of perspectives across the team, and that's why we have a world-class design team, world-class front-end engineering team that I think kind of leads that effort. They're much better at me than those things. But yeah, I mean, look, I think this is definitely a collaborative industry, right? We and anything we do with intention. We'll continue to do that. The execution, will be as good as we can make it, and we'll continue to make it better.
Well, guys, I think that was really well said, and thank you for both coming on. I think that says a lot. I know we probably want to close up, but I have something that I promised the research analyst that I'd ask you guys. This has to do a little bit more in just like looking forward and kind of the future of lending protocols. Edgar, you mentioned that you prioritize, for example, liquidity providers or the lenders on your protocol. And one thing that we've been seeing happen in Ethereum and some of their spaces is professionalization of the LP providers. So like Uniswap is a very good example. It went from kind of being a lazy LP to now you have to actively manage your position with concentrated liquidity. And then we've also seen Blur. They have their product Blend that relies on sophisticated actors to provide liquidity as well, which is like customized LTVs and which assets you want to provide. I'm curious on how you think the future of lending on your protocols will look. Like, will the LPs continue to be in this position where you just assume it's almost a lazy position to just provide liquidity? And maybe with that, I don't know if this is part of it or not, but you mentioned that concept of cross-collateralized pools versus isolated pools. And maybe if you could tie those together and just how you think the future of your protocols will look like.
I think we've seen an interesting trend in the lending space that people start off risk on when they're new, and then they become more and more risk off as they operate. So many examples of this. One example is Compound V3, which really added more restrictions in V3 than in V2 to isolate risk better. And I think this is a really interesting trend, and I've been thinking a ton about that after the chaotic markets that we saw last year around this time. And I've been thinking a lot about like P2P kind of order book based loans, and kind of similar to what Blur has done with Blend. And basically, the problem with pool to peer, which is the model that we're all using right now, is that the pool, the risk is pooled by everyone, and like, you don't know who your counterparty is, right? Your counterparty is everyone else in the pool, which could be anyone. It could be a really safe guy who manages their position very well, or it's like a turbo degen. And by employing a more P2P strategy, you can limit your risk exposure a lot more because you have more control over who your counterparty is. So yeah, it's been something that we've been thinking about a lot. And I do believe that it's yet to be explored enough. Like, we haven't seen enough of that yet, but I know some projects are doing some in that vein, like Morpho and Ajna. I don't know if I'm saying that correctly, but yeah, and we're looking into that as well. We've been having a lot of discussions internally about how to design something like this that doesn't like reduce the UX, right? Because the V2 model in which everything is pooled, the reason why it's so strong is that it's super, super capital efficient, right? And that counts for a lot in terms of usability. So it's it's great if you can make a super secure thing, but I guess like the most secure thing in the world is a rock, right? But how useful is a rock? I mean, maybe not the best example because we built cities out of them, but like if it's just a brick, like if it has no functionality, it's unhackable. But yeah, how useful is that?
Ruder, is it fair to say that having P2P actually reduces an attack vector because right now you have governance controlled by tokens? And I actually know like a year ago with Solend, there was an issue with the whale making some votes on chain. And right now, like for different lending protocols, you use on-chain voting with tokens to determine what the LTVs are, what assets should be added, et cetera, because you're looking at this pool model and it controls that risk for everyone that's providing liquidity versus this P2P, every liquidity provider gets to choose for themselves.
Yeah, definitely. Governance is a really important aspect of this. I think that ungovernance is an idea that has a lot of merit to it. If you have a system that doesn't require intervention, that is super good for many reasons. People can build on top of it without having to be worried about that, about things changing underneath them, and the security assumptions are made super explicit up front. I think it's a tricky situation here as well because like the DAO risk governance model is quite difficult to pull off well. Like we see on Ethereum, like Aave, they have a DAO for any small change to parameters requires this, elaborate voting process. And we saw this being a real issue with the Curve incident, where the founder had a massive position and, everyone on Twitter knew that something had to be done about it. Gauntlet, I'm sure they identified this problem ahead of time, but it's like they couldn't really do anything about it because they had to go through this governance, which actually even got rejected. Like their suggestion to mitigate things was rejected in the name of decentralization. And on Solana, we've seen projects take a different approach, where the labs, basically, the labs entity is the risk manager and does a lot of sophisticated work to ensure that things are running smoothly. But I think a different approach is to just do away with all of this voting process entirely. Obviously, there's some real trade-offs here, but I think it's a very interesting model that the market could use, a little bit more diversity.
I have a final question. This is for the degens, so I'm sure you can predict what's coming. So I'm curious, now that DeFi 2.0 is back, right? You both tweet pretty positively about DeFi being back, and Solana is kind of seeing this new wave of growth. What do you think the role of tokens will play in the next year for the ecosystem, and how do you guys? What is your philosophy on like this points and token meta and Solana teams launching them more and more?
Yeah. Look, I think tokens are really important in crypto. They're the lifeblood. We wouldn't be where we are today as an industry without tokens bringing people in, all this excitement. And yeah, points is this new meta that has emerged in the last year, basically pioneered by Blur as they took on OpenSea. They added a points program to create a lot of hype and tease a token launch. And I think it works really well, but it can be a little bit problematic, especially when the period is so extended. This period of just building hype, no token yet. And if the points program is just a placeholder for some planned token launch with like a defined timeline, I think it's okay if it's like a short period of time. But the way that some projects have been taking advantage of points has been a little bit predatory, in my opinion, where it feeds off of the high expectations from users who basically, it's a complete black box for them. They have no idea what they're going to get. like everyone, it's kind of this unspoken thing. Everyone knows that they're farming for tokens. So you can't just say like, don't use the platform if you don't want to farm or don't expect anything, because like everyone knows it's like the quiet part, right? Like everyone knows that people are farming this for tokens. But yeah, basically the parts where the payoff, the actual rewards are unknown and the timeline is arbitrary and can like all these things can also be changed retroactively. Specifically, like let's say a project was intending to give out a certain amount of rewards, but then prices pump by 5x, then they can just like reduce the rewards that they end up paying out by 5x, rather than letting the users get the benefit. So the way that Solend has approached incentives is initially we had a liquidity mining program where we just paid out tokens for incentivizing certain behaviors on the platform. And then more recently, we turned that into a points program where we would give out a basket of rewards. So in the last round, the last season, we gave out Solend tokens, Pith tokens, and also Tensorians, which pretty crazy. They're at 110 SOL now. But our approach has been quite different in that, like from the start, we were upfront about what the rewards are going to be. We said it's going to be minimum this, and that's not going to change. I mean, it could go up. It did. We added more rewards later as we finalized partnerships, but it can never go down. And the timeline is known up front. Like we said, it would be 3 months, and the rewards actually were distributed 3 months later. So I think I don't think points are going away anytime soon because it's such a like superpower for projects to use. But I do think it's a little bit an abuse of this by like leading people on for so long. And I wish for users that we would not do this, but I don't really see that happening because it's just like too profitable for projects to keep doing this. But what I've been trying to do on Twitter and in different venues is put some pressure on this to hopefully change the view on this, and maybe one day we'll all agree that points are bad. Which there's been a lot of discussion around this, especially recently, that it's not the best for users, and we can hopefully evolve to something that actually is fair for everyone.
Look, points are not new to crypto, right? Or sorry, they're new to crypto. They weren't invented in crypto, right? Incentive systems have existed long before Web3. What you see with incentive systems that specifically pertain to startups, and I'm thinking about the good things and the mistakes that I've seen in my time at Uber, my time in Silicon Valley, around that, my time in crypto as a user, as an observer, my time as a participant in crypto, is that creating closed-end incentive systems is a valuable opportunity to capture long-term users who really integrate into using your product, who integrate into your community, who ultimately are the foundation, the bedrock, right, of the platform that grows, right? Incentive systems also can be super dangerous. They can muddy success metrics. They can mislead teams and communities into thinking that there's product market fit where there's not. And they can entirely change the type of user who uses your platform, right? Which can just completely change the experience, especially in with products that have strong market effects, strong network effects, like those in crypto, right? It can completely change the experience for all users on a platform. I mean, look at what happened after the Jito token launches, right? Everybody from outside of Solana hears about airdrop farming, right? And a number of spammy, user archetypes start permeating this ecosystem, right? It's not healthy if those folks farming airdrops are not intending to be long-term users, right? If they don't become long-term users, it's just a pump and dump. Crypto has seen this 1,000 times, right? Look, from my perspective, like, MarginFi is a decentralized protocol in the making, right? Fundamentally, that means that a token has to exist and has to should fuel the operations of a decentralized protocol, right? Be involved in governance, be involved in utility. We've seen interesting models with protocols leveraging native tokens as forms of gas within the protocol, other types of like really interesting kind of dimensions of utility. Governance has been a long-standing work stream in crypto. There have been some decent governance architectures. There have been a lot of unhealthy ones. We think that much more effective ones can be designed in the future. But the key thing that I'm thinking about, right, is rewarding users who are contributing to the foundation and the infrastructure that is becoming MarginFi, right? I'm not interested in inefficiently spending incentive capital, whether that's tangible capital, whether that's social capital. I'm just not interested in it, right? There are tons of pump and dumps, tons of opportunities for, free mercenary money in crypto. I think, all of that is arbitrage. That is a mark of an inefficient ecosystem that is getting more efficient over time, right? Arbitrage always closes. It's fundamentally the nature of arbitrage is that as systems become more efficient, that arbitrage opportunity gets smaller. Where real wealth is built, where it's compounded, and where quality of life is improved is in growing the actual pie, right? In actually creating and compounding value. And incentive systems should be just an input to that, right? When you look at how successful incentive systems have worked outside of crypto, right? Where we've seen kind of the most mature incentive systems, you see that incentivizing long-term contribution, long-term participation, often with more abstract value proposition, right, is what is most effective, right? Because generally speaking, mercenaries have extremely low risk tolerances. They're looking to quantify how much they can make on a very short timeline so they can get in, get out, do something else, right? I don't think that's healthy for early stage projects, right? As an early stage project, why would you be interested in capturing that mercenary usage, that mercenary liquidity for what ultimately is a really short time period, right? I think what's much healthier is to attract the people that are in it for the long run. And then, importantly, provide a system that rewards them with compounded wealth in the long run, right? And so that, like, when I think about point systems, that's really what I think about. But point systems to me are just like a subclass of incentive systems more broadly, right? Now, look, like across the whole industry, there's I think points like kind of took off, right? Blur did it, we did it, Jito did it, everybody started doing it. And there's a lot of copycats, right? That folks, teams that are just implementing things, I think, without like a principled vision. You'll always have that, right? And I think those systems are bound to disappoint. Again, like this is one of the important values of having a free market, of having permissionless systems. Like people can choose and propose to do what they want to do, and the community, the general public, can respond accordingly to it, right? So I'm not going to argue for the censorship of permissionless systems. I think permissionless systems are incredibly important to keep permissionless. I will say that there are some folks doing this in a principled fashion with long-term vision, and there are folks who are not doing that.
Well said. Well, I can say this at least with the airdrop season and also point season, it's way more fun. So we'll take the good and the bad of it. But that was really well said. Guys, thanks so much for coming on. I think this is really important conversation to have, and also just for the ecosystem and other projects in the space. I know it's, there's some drama on Twitter. I think this conversation was awesome. And I personally learned a lot from both of you on this. So thanks so much for coming on.
Yeah. Thank you. Yeah. Anytime. And Edgar, let me know what size shirt McBrennan wears. I'll send him a Solend shirt.
He's an extra large. He's a men's extra large.
All right, so I think we got some of those.
Yeah, I'll take one of those.
If we gave out margin merch, I would give you some, but we don't. It's kind of a principle of ours. The only way you get margin merch is to join the core team. So, I don't want to break policy, but maybe in the future.
All right, guys. Thanks again for coming on. We'll see you next time. All right, I've got a little ending note here. First, thank you so much for listening to the full episode. If you really liked it, hit subscribe. But secondly, make sure you sign up for DAS. This is Blockworks' biggest institutional conference happening in London in March. I've included a link in the show notes and also a discount code. Get 20% off. Make sure to use Lightspeed 20 when you sign up. All right, I'll see you there, and I'll see you next time on Lightspeed.